Components of a cash flow statement. How did you make your money, and where did it go? In a Fortune 500 boardroom, if a CFO says, "We have 10 million in the bank," the immediate follow-up question is, where did it come from? Did we earn it by selling products? That's a good source. Did we borrow it? That's a risky source. Or did we sell off our furniture? That's desperate. 1. To understand the true health of a business, we classify every dollar that moves in and out into 3 specific buckets or activities. This classification is the global standard for financial reporting. They are operating activities. These are cash flows related to the core business operations, including cash received from customers, cash paid to suppliers and employees, rent, utilities, and other day-to-day expenses. This component shows whether the core business generates sufficient cash to sustain and grow itself. 2. Investing activities. Cash flows from the acquisition and disposal of long-term assets such as property, plant, equipment, and investments. This reflects how much the business is reinvesting in its growth or divesting assets. 3. Financing activities. Cash flows related to transactions with the company's owners and creditors, including issuing or repaying debt, issuing equity, and paying dividends. This indicates how the business finances its operations and growth outside of its core activities. Understanding these 3 categories is the first step to building a cash flow forecast that reflects reality, not just optimism. The mechanics of liquidity, inflows, outflows, and net flow. While the activities tell us the source of the money, the inflow/outflow logic tells us the direction. This is the plumbing of your business. Cash inflows. The faucet. This is any money entering your bank account. It increases liquidity. Examples are cash sales, collections from debtors, loan proceeds, grants, asset sales, and interest earned. Cash outflows. The drain. This is any money leaving your bank account. It decreases liquidity. Examples are paying suppliers, paying rent, buying equipment, paying expenses, making asset purchases, and repaying loans. Net cash flow. The water level. This is the difference between inflows and outflows over a period. Positive means surplus, negative means deficit. The formula is total inflows minus total outflows. In practice, a positive net cash flow means your liquidity is increasing. A negative net cash flow means you are burning cash. While a business can sustain negative net profit temporarily due to non-cash expenses like depreciation, it cannot sustain negative net cash flow indefinitely. Practical application: the GreenLeaf bakery scenario. Let's map the GreenLeaf bakery data to these concepts to see how they look in the real world. A. Operating activities, the daily grind. These are the day-to-day cash flows related to producing and selling the products. In our forecasting model, this is the most active section. Let's classify this activity into inflows and outflows components. GreenLeaf bakery inflow example. These are cash received from selling the classic sourdough loaf at $3,500 per unit. GreenLeaf bakery outflow example. These are cash spent on variable costs like paying for flour and yeast, direct materials, at $955 per unit, and cash spent on overheads like paying the monthly rent of $450,000 and staff salaries of $850,000. Significantly, if operating inflows do not cover operating outflows, the business model is fundamentally unsustainable. B. Investing activities, building the future. These are cash movements related to long-term assets, capital expenditures, or CapEx, or money made from selling them. These are usually large, one-off outflows or inflows. GreenLeaf bakery outflow example. This refers to cash spent on buying equipment like a new industrial mixer for $2 million in month 4. GreenLeaf bakery inflow example. This refers to cash received on selling equipment like the old delivery van for $800,000 in month 3. Here, the month 4 investment represents a significant outflow, which will likely make the net cash flow negative for that month. but it is an investment, not a loss. Your forecast must show this distinct spike so the owner knows to save cash in months 1, 2, and 3. C. Financing activities, funding the gap. This is the cash moving between the business and its owners or lenders. GreenLeaf bakery example. Inflow scenario. To pay for that industrial mixer, the owner injects $1 million of personal savings. This is equity injection. Outflow scenario. The business pays $100,000 monthly to service a small business loan. This represents principal plus interest. The significance of this section is that it shows how the business stays afloat when the operating cash is not enough. Integrating components into the forecasting template. How do we put this all together in Excel? For a robust Fortune 500 style forecast, we combine the activity view with the inflow/outflow logic. The template structure strategy. Instead of a jumbled list of transactions, we structure the Excel template to calculate a subtotal for each activity scope. This provides clarity on why cash is moving. Below is the proposed layout for the cash flow template. The cash flow for operations consists of cash receipts as inflows and fixed and variable costs as outflows. The cash flow for investing consists of asset sales as inflows and asset purchases as outflows. Then, cash flow for financing consists of equity injection as inflows and loan repayment or dividend payments as outflows. Why this structure works. 1. Clarity. If total net cash flow is negative, the user can instantly see why. Is it because operations are failing? That is, row 4 is negative? Or because we bought expensive equipment? That is, row 7 is negative? 2. Practicability. It separates controllable monthly costs, operations, from strategic decisions, investing/financing, thus allowing for better decision-making. By structuring your template this way, you aren't just calculating a bank balance. You are separating the noise of buying equipment from the signal of daily sales health. This is how you forecast with professional precision. Conclusion. Cash flow is more than numbers on a spreadsheet. It is the story of how money enters, leaves, and sustains a business. By classifying movements into operating, investing, and financing activities and tracking them through inflows, outflows, and net flow, leaders gain clarity on both the source and direction of liquidity. Whether it's daily sales, long-term investments, or funding gaps, this structure transforms raw transactions into actionable insight. In practice, it ensures that every dollar is explained, every decision is visible, and the business's financial health is grounded in fact, not assumption.